So today I want to talk about data mining. I want to talk about it in the context of improving our investment outcomes. Now, if I look on the web, I'll see pictures like this one where it talks about 8 ways to use data mining to improve your business. Now, from a business perspective, a non-investment perspective, maybe it makes sense to look at data. Maybe we've been ignoring data for a long time. And if we actually look at this data, we can make better decisions. But from an investor's perspective, from an investment's perspective, it's typically frowned upon to data mine. It's seen as a way to kind of make your investment outcomes worse if you go through this exercise of data mining. So what am I talking about here? Well, I think from an investment perspective, we're trying to determine relationships. We want to be able to look at some metric and say that is related to future outcomes, future investment returns. And if that relationship is real, then we can use that to predict what those investment returns are. For example, not surprisingly, bond or fixed income yields are related to investment returns from fixed income instruments. Now you can see a chart here that kind of demonstrates that. We've also seen that the CAPE ratio is indicative of future returns. So the lower the starting CAPE ratio, the higher the subsequent future returns, and then the higher the CAPE ratio, the lower the subsequent returns. Now, you can see that in this chart here with many different countries. I personally have talked about the CAPE ratio a number of times. You can check out all of these videos here where I talk about the CAPE ratio, lots of good information there. I also talk about how I don't like the CAPE ratio because it is price over earnings. So we really need to flip that around. It should be earnings over price, or sales over price, or cash flow over price. I talk about why that's the case in these videos here. Check that out. So lots of good videos there to check out. Now, of course, the problem is in financial markets, there's a ton of noise. And when we see a signal that appears to have a relationship to future returns, it's not always perfectly clear whether that is a real signal or there's a lot of noise. There's some noise, terrible, we don't want it. It makes it harder for us to make those investment decisions. It makes it harder for us to know whether or not that relationship is real. So what can we do about it? Well, the idea here is we're going to do some statistical tests to give us a confidence level about how real that relationship is. So for example, we might want to say, do a test and say, this signal, we're 95% sure that that relationship is real, okay? So what we're trying to do is we're trying to avoid type 1 and type 2 errors. We're trying to make the correct conclusions. That is, there is no real signal and we conclude that there is no real signal, or there is a real signal and we conclude that there is a real signal. Those are valid, good conclusions, but what we don't want to do, kind of the opposite of that. We don't want to conclude that there is no signal when in fact there really is a signal. That would be problematic. We would be kind of missing out on that relationship. But even worse would be to conclude that there is a real signal there when there isn't. So those are because we would kind of invest based on that signal that turns out is complete nonsense. So we need to understand whether or not these signals are real or they're nonsense. We want to avoid type 1 and type 2 errors. To put type 1 and type 2 errors in perspective of human beings, a type 1 error would be like telling a man he is pregnant. That would be a false positive. A type 2 error would be like telling a woman that is pregnant that she is not pregnant. That is a false negative. So we're trying to avoid those errors. So if we can do that, if we have these tests of significance, why don't we just do that and then just test everything out there? Now, the problem with that is these significant tests are really based on one test. So we can be 95% sure that something is real if we do one test. But the thing is, we have tested hundreds of so-called factors out there to see if they are predictive of future returns. And when you do that, you're going to find something that appears to be real that isn't. It's just the way statistics work. So in this fake news story here, we look at 20 different color of jelly beans, and we find that one of them is related to acne. It's kind of this play on things here where, if you have 95% confidence levels, that means 5% of the time you're going to falsely conclude that there is a relationship there. But if you do 20 tests, then you would, even if all those are bogus, you would expect to find that one comes out to be true. Hopefully that makes sense. You can think about that a little bit more. Now, to put it in a little more concrete terms, if you do one test and the probability of finding that fluke, like that jelly bean one, is 5%, okay, which is what our confidence interval says. But as you increase the number of tests, that becomes more problematic. So in the jelly bean example, if you test 20 different jelly beans that are all complete nonsense, you're 64% chance likely that one of those is going to kind of you're going to falsely conclude that it is related to acne. Another example we might do would be kind of looking at the letter that a name of a company starts with or its ticker starts with. Okay, so that'd be between 26 different options here. We're 74% likely to find and conclude that there is a relationship there, even when there isn't. If we go to 50, that becomes 92% chance. And again, we're talking about here, we have tested hundreds of factors. So it is extremely likely, it's almost 100% likely that we have found relationships that appear to be true that are not at all valid there. So if you do the data mining, you're going to come to conclusions that are patently false. And my friends, that is data mining. You got to be really careful. What you want to do is you need to have a prior basis to justify why that relationship would make sense before you even test it. If you can't think of a reason why there is a relationship there, then you shouldn't even be testing it. Thanks so much for listening. I am Brian Kozlowski.